Now, we want to stick with the markets and bring in Kristina Hooper. She is the Invesco Chief Global Market Strategist. And Kristina, always great to see you, and thank you for showing your face here on a Friday afternoon, where I began by talking about the Fed. Has it all been about the Fed this week? Just wondering if there's anything else on the radar and what might be coming in the weeks ahead, as most people have their heads, filled with visions of sugar plums, something like that.
Well, Jared, it's been a 1-2 punch. It's been about the Fed and then some weaker economic data. And that has created a picture of a Fed that is being ruthless about inflation and perhaps careless about the economy, not recognizing in particular how much impact, how much damage what it's done thus far has already had on the economy. I think retail sales really spooked markets yesterday, and we've seen more data since then. And so the general concern is that we're headed for a recession based on what the Fed has already done. And on top of that, the Fed seems poised to do more. Now, the silver lining is I think the Fed is talking tough, but I do believe that it will hit the pause button if it feels more comfortable about inflation, and certainly if it feels as though it is sending the U.S. economy into some kind of traumatic decline.
Nice to see you, Kristina. I love some of the language you use in your notes. So I'm just going to imagine I'm eating popcorn as you describe why this market dynamic is like a typical horror movie fake out.
Yes. Well, what investors are concerned about, market participants are concerned about, is that inflation is going to rear its ugly head. I think there's some uncertainty on the part of FOMC participants that Jason Voorhees will get up again, as we've seen tons of times in tons of movies. And so I think that fear is there, and it's born out of reality. Recall back in the 70s, the Fed thought it had killed inflation, only to see it come back up stronger. And so that is certainly the frame of reference they're using as they talk tough and act tough.
Hey, Kristina, I want to talk to you about the bond and the currency markets. What I noticed Wednesday, which was interesting, still sticking with the Fed here, was that even though it seemed like the market in terms of equities was taking Jerome Powell's hawkish rhetoric at face value, finally, maybe at least for a few hours, though, the dollar didn't really move that much. Wondering if that means anything to you. And then just in general, what is the bond market signaling with everything we've been talking about with the Fed and whatnot?
Well, I think that what we're seeing is currencies and certainly the bond market being less reactionary to Fed talk, certainly less reactionary to the FOMC meeting, and is looking ahead. It's certainly suggesting that inflation is more tame than what many fear, just given past history and certainly what the Fed seems focused on. And I think that should be comforting to investors. Certainly, we should hear tough talk because the Fed doesn't want financial conditions to loosen at this point. It wants to get the job done. And part of that is talking down markets.
Yeah, it's interesting because Jen Schonberger had some Fed speak today, and Mary Daly also said she doesn't know why markets are so optimistic about inflation. Of course, that was earlier today before another sell-off. Are markets beginning to listen, though, on inflation?
Markets are certainly, I think the stock market is listening about inflation and is reacting. And I think that's likely to continue, at least in the near term. But there is going to be a tug of war, a push and pull almost on a daily basis because we are getting closer to a Fed pause. And the reality is, once a Fed pause is imminent, I think we're going to see stocks err on the side of a gravitational pull upward.
All right, Kristina, notwithstanding whatever fluctuations we may see in the next couple of weeks, let's think about the big picture next year, 2023. Any themes that you're seeing emerging, and how are you positioning yourself and your clients for the big change of years here?
So, Jared, this might be boring, but it really is a road to normal. It is going to be a bumpy road to normal. But normal is better than what we've seen. We've seen an extraordinary year for inflation, and not in a good way. We've seen an extraordinary year for central bank policy, and again, not in a good way. And we've seen an extraordinary year for asset class performance, and not in a good way. So next year, I think we are going to be on a road to normal. It's not going to be easy. It's not going to be smooth. But I think what we're likely to see is more normalized asset class returns, more normalized central bank activity, right? Rate hikes of 25 basis points as opposed to these jumbo 75 basis point rate hikes. And of course, inflation moving to normal. It's not going to get there. It's not going to reach the Fed's target in 2023, but it's certainly going to look better. It's going to moderate over the course of the year.
Not going to be easy. Invesco's Kristina Hooper, always great to have you. Enjoy the weekend. Thanks so much.